0% tax on long-term capital gains. It's a real thing, and you probably have heard about this before, but there are a lot of nuances around it, just like everything in the tax code. They make it complicated. Some would say on purpose, but we're not going to talk about that today. What we are going to talk about is how to use it for our benefit, how to understand the nuances, work through it, and see where this strategy can work really good for some people in retirement. So let's jump in. I have a couple visuals here to help us talk through the concepts. The way we're going to think about the tax brackets here, the 0, the 15, and the 20, we're going to think of them as buckets. And what flips, what spills you into the next bucket is your taxable income. So for our purposes, our married couple, we're going to say that they're above the age of 65. For deduction purposes, that would bring their standard deduction with the age bonuses and the senior bonus up to $47,500 for the year of 2026. So that's the number we're going to be looking at for our deduction. And we're really interested in this spot right here, this 0 to $98,900. That's the bracket in which the long-term capital gains are going to come and flow to them tax-free at 0% for federal. So this doesn't include the states that do still tax these capital gains. We're talking about federal taxes in this case. So this is the visual, and this is how I want you to think about it. The first bucket that gets filled with your taxable income, which is all types of things, is the deduction bucket. And that's $47,500 for our couple here. When that bucket gets filled, since we're talking about long-term capital gains, that's when our 0% bracket starts getting taken into account. If that 0% bracket bucket gets filled all the way up, so if you crest the top of 98,900, any of those other long-term capital gains will then spill over into the 15% bracket here. So for example, on $146,400 of gains, the deductions get filled, spills over, and then our long-term capital gains bracket bucket gets filled. This happens to be the exact amount, the maximum amount of gains that you could take, assuming you had no other income sources, which is a pretty rare situation. So this is just for illustrative purposes. Let's move on. Take a long-term capital gain of $150,000. The deduction gets eaten up. The next bucket, the first 0% bracket bucket, gets filled, and then $3,600 spills over into the next bracket. And so the $3,600 is the only piece that gets taxed at 15% long-term capital gains tax. The rest of it still stays at 0. So $540 would be the amount we pay in this situation. Now let's look at something slightly more realistic, and let's add in some other sources of income to see how that affects what's going on here. In this example, we're saying that the couple is going to take $40,000 out of their IRA. So as we know, that gets shows up in our income. That starts filling up our deduction bucket. And then they want to maximize the amount of long-term capital gains that they can take at the 0% bracket. So they take the full $106,400, and that fills up that next bucket all the way to the brim without anything spilling over. Again, a very simple and potentially unrealistic situation, but this just shows a little bit more nuance on how income comes in and buckets get filled. Now let's move on to another scenario. Here, the couple is taking $90,000 from an IRA, and they want to see how much is left over after they take 90 that they can take in long-term capital gains. And in this case, it's $56,400. That's what's left after they take $90,000 from the IRA. So when we talk about long-term capital gains, we're talking about the gain specifically, and that's really the only thing that's considered in filling those buckets. So not the basis. For example, if you bought a stock position in a non-qualified account, like a standard brokerage account, and it cost you $40,000, you held on to it for longer than 1 year, which is the limit for long-term capital gains to be considered long term. It has to be over 1 year. And let's say the stock grew by a large percentage and you ended up with a total value of $100,000. $40,000 is what you paid for the stock, and $60,000 is the gain for a total value of $100,000. When you sell the stock, only the 60 goes into filling these buckets. The 40 is what you paid for it, and so the 40 flows back to you as a non-taxable event. The 60 is what you gained from it, so that's the amount that is taxed. That's the amount that adds to the deduction bucket and then flows into the long-term capital gains bracket bucket here. Now let's talk about Social Security, because this is where the sliding scale gets a little bit more nuanced and complicated. If you're not familiar with Social Security, how it is taxed is based on how much income you have. And so by taking some long-term capital gains, you're affecting your overall income. And so Social Security is looking at that to understand how it's going to itself be taxed. And if more of your Social Security is going to be taxed, that means more of your deduction bucket is going to be filled. So, and that affects how much long-term capital gains you can take. So this is where you really want to get, dialed in with your numbers. If you're at the point where you're already drawing Social Security, you want to understand how much of that is going to be taxed based on how much long-term capital gain you take. Even if the long-term capital gain is taxed at zero, what it does is it drags more of your Social Security benefit into the tax equation, and that's where things can adjust. So I have a little sliding scale here. Right here is our long-term capital gain amount, which we're going to adjust. We're saying that in this case, $60,000 is the Social Security benefit. So as you'll see, as we adjust our total income by taking more long-term capital gain, more Social Security gets pulled into the equation. At a certain point, we're maxed out because we hit the 85% tax bracket for Social Security. And so 85%, 51,000 of the 60,000 is being taxed. And so that maxes us out. And we can see that we would have 95 is the amount that we could take to max this out. And so here the federal tax in this case is based on the Social Security only. So you can ignore this for this situation. Really what we want to understand is how much of that benefit gets pulled in, which then takes up some of our bucket here. And then you can see what happens if we spill over, and that's when some of that long-term capital gain is starting to get taxed at 15% here. Another interesting way that I've seen this used, and we've actually used it for clients as well. In our situation, it was an individual who was actually very young. He was deployed at the time, and so his taxable income was very low in that year. And we were able to sell and take some capital gains on positions and then buy those positions right back. And there is no wash sale rule or anything when it comes to gains. And so it doesn't necessarily mean that you have to close those positions out. But what we did was we eliminated the unrealized gain for that individual. If you're in retirement, it may be different, and there may be money that you're pulling out to use. But in that situation, you can reinvest right back into that same position and just adjust your unrealized gain. Now, the last thing to consider is that Roth conversions play a factor here too. So if a Roth conversion is part of your strategy, that's going to take up some of your long-term capital gain bucket. As you know, a Roth conversion happens when you're pulling money out of a traditional IRA. It gets looked at and it hits your income. That withdrawal does. Then it gets converted to a Roth. And so for every dollar that you're converting above, of course, your deduction, that's going to take away from a dollar of long-term capital gains in this 0% bracket bucket. So just something to consider if a conversion is also part of your plan. That's all I have for you today. I hope that was helpful. My name is Ben Edmond. I'm a certified financial planner here in Connecticut. If you want to talk through your specific situation, run some numbers, feel free to head over to pasnaw.com. That's nau.com. And I'll also drop my email here in the description. That's ben@pasnautinvestments.com. I love talking about stuff like this. I love solving the financial problems of life. So if you want some help, feel free to reach out. I'll see you in the next video.